Hi guys. We start in about 3 minutes, guys. Yeah, go ahead.
ọmọ nìyí kí ló ṣe fọmọ yẹn.
Can you guys hear me? Okay. Hey guys, welcome to this session today. It's just going to be a webinar series on Zoom platform. And I think today we're going to talk about investing more or less. I wanted to talk about how to invest, and I have this topic here. I call it bulls, bears, and yields. Just trying to get all those terminologies into the topic or into the title, so we can just understand them and be more conversant with them. Just ground rules. I'm just going to try to talk slowly, so you guys can pick it up. And if you have a question, go ahead and ask. I will try to stop at certain markers and then take your questions, so that way I don't have to wait till the very end to grab everything. The session is more or less for the beginners, the guys that are not too into finance, but really want to understand what it's all about, how they can, uh, um, understand all these topics per se and all. So if you're advanced or if you know what I'm talking about, you can help out if you see the questions. But I really want to reach those guys and those participants that are not really, should we say, more conversant with finance and all that. So this is a topic: bulls, bears, and yields. So we're done with all the early talk. Let's go straight into this guy. Yeah. So this is sponsored by the Way I See It podcast. This is my podcast. I do it every week. Mostly on Wednesdays, I publish a series, and we talk about money, personal finance, economy, political economy, and how all that really interacts. So the podcast is sponsoring the Zoom meeting today. Thank you, podcast. So this is going to be our course outline. Just a brief introduction, then we'll talk about sources of financing, then equity and debt, and then markets and investors, and then we'll talk about the asset class behavior, how asset classes behave. You guys will basically understand what that means. And then we'll talk about how to build a portfolio. Yeah? Okay. So introduction, what's this all about? Like I said, it's a Zoom session that we're doing, and we want to reach out to those first-time investors or new investors or investors that basically want to understand really what's going on in the market. How can they build out a portfolio? What do all these terminologies mean? This is just what I want to do. It's just my way of, giving back and raising the financial intelligence of my followers and those out there. So that's basically all that it is. Feel free to talk to me on Twitter and also on the chat. I will see it if you do. Yeah. Now, sources of finance. Why have I titled this chapter Sources of Finance? Because this is why really we are investing. This is what drives investments. When companies or ideas or individuals have an idea, for instance, and they want to build out an empire, or they want to basically build out a product or service, they need money. And it's because there's a need for money that those companies basically then go to the market. It could be the bond market or it could be the capital market, more or less. And then they request or they ask investors to come in and partner with them, either by debt or by equity, to raise funds. So sources of finance is really what drives and what creates those securities that the investors can then partner with those entrepreneurs to then be a part of their success story. That's why I've put this as sources of finance, because this is what drives and generates those asset classes that we then invest in. So every company is going to raise money in three different ways. Every company. If the company is making profits already, it will raise money from profits of the company. If the company has got investors, maybe seed investors, angel investors, maybe family and friends, those guys can invest and the company can run with that. And also the company can then also go to the bank and take a bank loan, traditional financing, and also run the company. So those are the three ways in which a company does request for funds. If you notice, we're going to be right in the middle. We're going to be falling into the seed or angel investors, or basically investors per se, because it is when, for instance, Elon Musk has an idea to create EV vehicles. He needs cash. he can then sell equities, he can then sell bonds. And once he triggers that decision to sell, to invite investors into his company, that's when we can then invest by giving him our cash to put into his idea. The idea being for us, we want to earn a return back on making that investment. So sources of finance is basically what drives the creation of financial securities. And those financial securities is basically what attracts us and allows us to then invest in those opportunities that are created in the marketplace. Yeah. So very, very important. And there are two basic sources of finance. There's going to be the debt financing, there's going to be the equity financing. So debt is more or less loans. So when a company is doing debt financing, the company is basically taking loans. So the company is saying, borrow me or lend me or whatever, and I'll pay you back. In this case, the company, or let's just use Elon Musk, he's keeping ownership. He's not going to give you any owner, more or less. He wants to basically give you, you give him money and he's going to pay you back your cash. You have no ownership. But equity is when the company or the individual or the entrepreneur is selling a part of his idea or his company to you. He's saying, come and be an investor with me. So you are putting in capital into the company. You are then going to be sharing in the profits and the loss of that institution. If the company fails, you've lost your money. If the company does succeed, like a Tesla, then of course you have also made a lot of money. So I put it all here for you guys, basically trying to do the bonds and the shares. So of course, bonds mean debt, and of course, shares mean equity. So when you are doing the debt investing, i.e., you are buying the debt of a company, that's when you are buying the bond of a company. In which case, you are making a loan to the company. You are more or less a banker to that company, and you are getting your interest payments quarterly or semi-annually, no matter how the company sets that up. And then, of course, you get your principal at the end of maturity. And your income or the interest payments are guaranteed to you, i.e., the company has to pay you. It doesn't matter if the company is making a loss or making a profit or whatever, it has to pay you. It can't say, I had a bad quarter, so I won't pay you. It's basically going to pay you whatever happens, yeah. But on the flip side, if you invest in shares, which means you're investing in equity of the company, you are trying to be a part owner of that company. So you are buying into the ownership of the company. And of course, you want to partake in the expectation of growth by profits and dividends and share price appreciation of that company. Now, there is no guarantee of a dividend. The company could make a dividend, the company could make profit and still not pay a dividend. But the company is you're going to be a part of that company's success. So you own the equity or you own part of that company. And that's the advantage for you, more or less. So, in one hand, you're like the banker, and on the other hand, you're like the owner. And is this two competing ways or means of raising finance that then provide an opportunity for us, the investors, to come into the company and then be an investor? Yeah. Let's now talk specifically about equity and debt and then try to see what we can learn from that. Or, like I said, equity is basically the shares issued by the company. So, when you are doing equities, you're trying to buy into the company as an owner. You have the same rights as the owner. The owner just has more shares than you and could have more voting rights than you. But your shares have the same powers in most instances as the the entrepreneur or the owner or the founder of the company. You basically buy into that company by investing in the share capital of that company, and you then become an owner of that company. Correct? Okay. A share is sometimes called a stock. It just represents a claim on the assets of that company. So it's a proportional, but it's not mandatory. What that means is that if the company has 100 shares and you buy 10, then you are going to get 10% of the assets or the declared profits of that company. But it's not mandatory. The company does not have to pay a dividend. But if the company does pay a dividend, you get a proportional share according to your ownership, right? That's basically what that means. It can also represent voting rights, and in monetary terms, it's normally issued at a par value. So whenever the company issues shares, it's going to be issued as a par value, say maybe a 1 naira or 50 kobo, and then from there, that equity then keeps on rising in relation to how well or how bad the company is doing. So that's equity is more or less you're buying an equity or a share, and you are an owner in that company. And of course, there are all these terms you hear when you hear about the stock market or equity investment. I just want to list them out and make sure we just understand what they all mean. So the authorized share capital, that's basically what the company is authorized to issue by way of shares. Then the issued share capital is more or less what it has issued from the authorized. And of course, the paid up is when it has issued those shares. Are those shares paid up by the subscribers or the investors? If they have paid up the funds back to the company, then that becomes the paid up share capital. And of course, the capitalization is a number of shares multiplied by the share price. So let's go over it again. So the authorized is the total number of shares the company can issue, total. And of course, the issued shares is what it has issued. And the paid up is that issued shares that have been subscribed by cash by the investors. And then, of course, the capitalization is the number of shares multiplied by the market price. So when you see a blue chip company, what they're basically saying is that the market capitalization, which is the number of shares issued and paid up by that company, multiplied by the share price of that company, gives it a very, very high value. So it's a blue chip or a highly capitalized company. That's basically what a high cap stock means. It means that the capitalization, which is the number of issued shares multiplied by the market price, is making the company big, i.e., by number of issued shares. Yeah. All right. Let me see. Just take a peek at you guys and your questions. Okay. Now let's pay attention to this guy. To this, guys. This is basically how companies then issue shares. So we've talked about the share capital and all that. And a company, when you are buying shares, you are buying ownership into that company. But there are also many ways you can buy ownership, or there are many ways, let's say, the company can offer you to come into the company as an owner. The first time is if I'm setting up a company, right? I could talk to my friends and say, hey guys, I have a company, I need $1,000. Can you guys invest $100 each? And I issue them shares at the very, 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 very beginning, and they become, foundation shareholders per se. So as I'm starting the company as a new company, I could issue my shares to my family, to my friends, to private investors. I'm not a public company. I just do a private sale to these guys, and they give me shares. That's fine. That's basically what you call like the startup or the angel or the seed round. That's basically what that means. But then as I get a lot bigger, I could say, hey, I want to do a private placement, which is almost the same thing, but it's just that I'm doing it in a more formalized setting. So I might even hire an investment advisor or an issuing house to do that for me. The shares are not going to be publicly offered. I'm not going to go to the public and advertise this offer. It might be a larger offer, but it's going to go to what we call accredited investors, i.e., high net worth investors or institutions. And I'm going to go private to them and say, hey, would you guys want to buy shares in my company? And then they basically give me the funds, and I then basically use that for my operations, and they become shareholders. Yeah. Where it then gets interesting is when you then have what's called the initial public offer. In the initial public offer, we then say that the company then goes to the general public and says, hey, I want to basically sell shares to you guys. You guys can all come in and invest in my company, more or less, right? And then the sorry about that. The company can the investors can basically buy into the company, and when they buy into the company, they are then able to then say, hey, um, we are owners of that company, and then we can then basically take funds and then run with it. And the company can then have what's called annual general meetings where people can come in and vote. Now, keywords for you guys to look at. If you want to ask questions, I can see them, so that's fine. Yeah, yeah, go ahead. If you ask, I'll see it. Don't worry about it. Yeah. Yeah. So the IPOs and SPAC, great question. I'll address that pretty soon now. Yeah. So let's talk about keywords, guys. So I want you guys to pick from this is the initial public offer and then the offer for sale. So initial public offer or the IPO, you see the word initial in front of it. That means that's the very, very first time the company is selling shares to the public. Initial public offer, right? That's the first time the company is selling shares to the public. In a direct listing, there's no underwriter. The company basically goes to the stock market and says, hey, I want to sell my shares. Probably I have guys that want to buy it, but I'm not going to get an investment bank to sponsor me on to underwrite the shares. Underwrite means that I'm not going to get a bank to say, hey, if people don't buy the shares, I will buy it from you. I'm just going to go directly to the stock market and offer my shares, and then people can just buy them more or less. It's a new thing that the New York Stock Exchange is doing. I think Nigeria is also trying to do that. It's just a faster way to get funds in. You don't have to then do the listing on the right and all that kind of stuff. Look at the last one there. That's the offer for sale. So we have the initial public offer, initial being the keyword. That's the first time you are selling your shares to the public. But the offer for sale, those shares already exist. So you are selling existing shares to the public. In the initial public offer, the shares do not exist. You are creating shares and selling to the public. You understand it? But in the offer for sale, the company already has those shares and it wants to offer for sale to the public, more or less. Yeah. Now, if you look at on the right hand side, you can then see the existing company. You can see that the company can do a public offer. So after the company has done an initial public offer, the next time it wants to sell shares, it's going to do what's called a public offer because it's no longer an initial. Same thing, it can do an offer for sale. And the company can also do a private placement. Yeah. So the key thing is that initial and public. Initial is the first time, and sale is that they are selling existing securities. Yeah. Okay, let me answer. I have a great question here from Yusuf Lawan. What is the difference between an IPO and a SPACs? And SPACs are these new investment vehicles. We would call them special purpose vehicles in Nigeria, but in the US, they call it special purpose acquisition shares, more or less. What those are is you can basically go and say you want to create a company. They call them companies to do anything. So you raise money, there is no objective per se when you are raising those funds. You're basically saying, hey, give me $1 billion and I'm going to raise this money. And if I see any opportunity, I will pursue it. So that's basically what the SPAC is. You're saying, hey, give me money and we're just going to wait for an opportunity and then we're going to invest. It's a new thing, it's catching on now. So normally when you raise money, you're going to say, hey, I want to raise money to buy Tesla shares, or I want to raise money to invest in this factory. But in SPACs, the guys are also going to say, I want to raise money and I'm going to see if I can get a new good opportunity. If you guys want to partner with me, give me your money, then we'll see what we can do. But an IPO is you are selling shares in a company. In an SPAC, you are selling shares maybe in a trust or a fund, and then that fund can then go buy a company. But the IPO, so an SPAC can have an IPO, if I can put it that way. The SPAC can have an initial public offering, and it can use the initial public offering funds to then go buy companies, right? So the IPO is the process, but the SPAC can be the vehicle. It could be a special purpose vehicle. It could be also a trust, right? So Yusuf, I hope I answered that for you. Yeah, great. Yeah, Temitayo, that question, we can do it later. I just want to focus only on questions addressing the Zoom, right? Thank you so much. Okay, so let's go to the next the next question, yeah? The next slide per se, yeah, oh Christ. Yeah, thanks for the questions. I will take them as soon as I can. when they say, this is another question from Emmanuel, when they say 50,000 ordinary shares for 2 naira 50 at 50 kobo per share, what does this mean? Great question. So 50,000 ordinary shares, yeah, those are the number of shares that are being issued to the public to buy. So the company is selling to the public 50,000 shares, and each share is going to cost 2 naira. But you have to sell the shares at the cost price. So the cost price is 50 kobo, but the company is selling the shares not at 50 kobo, but at a premium of 2 naira. So the company added 1 naira 50 kobo to that share price because it has a lot of demand, for instance, for the share. So the company says, I'm going to increase the price of my shares to 2 naira. So in that case, I then get 1 naira 50 kobo premium on those 50,000 shares that I'm selling. So all shares have to have what's called the par value. So the 50 kobo is the par value, to Emmanuel, right? Can a newly formed company do an IPO? Yes, as long as it's initial and you meet certain guidelines from the Securities and Exchange Commission and the stock exchange. They have their own rules. It's kind of stringent, but once you meet it, yes, you can do an IPO. It's rather expensive sometimes, so you just can't do it if you're just a brand new company without funds. You have to hire a manager and all that. Yeah. All right. Thank you guys for the questions. I appreciate it. So in this chart, what I've tried to do here is to basically show the process, yeah, how the companies go from ownership, say sole proprietorship, to say a public company. So you see a sole proprietor or a partnership or a limited liability company, we have lots of them, and that's basically how most of these companies start out. So they start up as LLCs, as C Corps and all that. They can do a private placement, that's fine, or they cannot do a private placement, that's fine. They can go directly and do an offer for sale. They can go and do an initial public offer as well. Like I said, the IPO is the first time they're offering the shares. The offer for sale is when they're selling shares they already own. And then they then become, you see, there's private ownership and then there's public ownership. So once they then go out and offer their shares to the public, they're now publicly owned, and then certain rules now apply to them. They have to publish their accounts into the public. They have to hold annual general meetings, and they have to release results. Just a few of the things that are expected from public companies. And they can then do public offers going forward. You can see there's no more initial in front of the public because they are now companies that are now registered. Yeah. Okay. Tons of questions. I'll tell you guys when we get to the when I get to the breakup point, I will just clear lots of questions. Uh, let's continue. So I have an example here. I have the Dangote Sugar Refinery PLC, and as you can see, yeah, it was an initial public offering. So Dangote was selling shares in Dangote Sugar Refinery for the first time. Can you see that initial public offering? But it says by the way of an offer for sale. So what that means that those shares already existed. That means somebody already owned those 3 billion shares of Dangote Sugar. And then those are the first time that those shares were being sold to the public. So more or less they were saying, hey, we want to sell those shares to you. And that's basically what they were then selling to the public. Yeah. Let me get a spotlight so you guys can see what I'm doing. Okay. There we go. All right. So that's you can see initial public offer right there, and then you can see by way of offer for sale. So this was the first time they were being offered. So this is just an example for you guys to see. And then because all these guys you see as the issuing house are the guys that are sponsoring. These are the issuing houses or the advisors that are basically offering these shares for sale. And then you can see what the question the guy asked me. So each share has a par value of 50 kobo. You see it here, 50 kobo, but they were being sold for 18 naira. So the par value or the minimum or the value that all the shares have to come out is 50 kobo. But in this case, it was being sold for 18 naira. So that's a premium of 17 naira 50 kobo on this share price. Sometimes it could be 50-50, sometimes it could be 51. But this is basically the premium that is on this price, and then you have to pay in full on application. So the issued shares being issued here are going to be fully paid up because the investors have got to pay in full once they invest. Yeah, that's basically what all that means. Application would open on that date and also close on that date, more or less. Easy peasy. Yeah. Okay. Now I got this guy from Tesla. This is the Tesla. Let me go back. This is the Tesla public offer of common stock. So you can see Tesla was doing an initial public offering of about 11,886,000 shares. That's what Elon Musk was selling at the price of $17 a share. So when Tesla did their initial public offering, they did sell those shares at right there at $17 a share. So you can imagine the profit that they've made now. Yeah. And then you can see the underwrite. This is how Americans do there. So these are the issuing houses: Goldman Sachs, Morgan Stanley, JP Morgan, and Deutsche Bank Securities. And this was basically when Tesla went to the markets, more or less, to get to sell equities. Yeah. Now, how do companies pay out? How do investments pay out? When you buy an investment, there are going to be two ways you're going to get your money back, either through price appreciation or through dividends and coupons. So the share price would go up or down and you make a profit on the capital gains, or you make a dividend, i.e. the company pays you a share of the profit or a mandatory share if you're a bond holder. So you can either make a dividend or a coupon, or you get a price appreciation. That's basically how you make money when you invest. Geez, lots of questions, guys. I will take care of them. Have no problem. Yeah, I will take care of them. Okay, let's just do them right now. Yeah. So I've answered this one. So let me ask a question by Yusuf. So the investors have no idea what they are investing in. Yes, when you do an SPAC, the investors do not know what the funds are being used for, because it's just a hedge fund guy or an investment guy saying, hey, give me the money and I'll go look for an opportunity, or if I see an opportunity, I will invest. At the moment he's raising the funds, there is no per se investment that he has in mind that he wants to take care of, right? Question from Oba: can different entities in a group of company offer separate shares? So can different entities in the group? No. When you offer a share, it has been a particular format. You can either do an offer for sale or offer for subscription. You can do them together, but each share offer has to be its own envelope. So you can't mix it. You can say you want to sell offer for shares, offer for subscription, but you can't really mix the two offers. I don't know if that makes sense to you, or ask me again if I didn't really answer that question for you. As a beginner in stock, I read that not all stocks pay dividend. My question is, those companies that do not pay a dividend, how will I make a company from those stocks? That's what I just answered now. So, Bode, the way you make, like Microsoft, in America, you find that most companies that are growth companies that are growing very fast, they do not pay a dividend because they believe that the best way to use their funds or their capital is to reinvest it into the company and then grow the company. So they don't pay a dividend. The way you make money is that the share price will rise and then you make a capital gain on your holdings. That's basically how you make money. Bitcoin, let's leave Bitcoin for now, right? Dangote Cement did a buyback of its shares. Why do companies take this step? Odili, if you just stay on the topic, I'm going to talk about buybacks. Just sit tight and I'll talk about it, yeah? Great. How do we get the slides for the presentation? After this, I will put the slides on YouTube, and I'll put it on Twitter and also my website. So you would get the slides and the full videos and all that, right? Don't worry too much about it. Please, can you throw more light on coupons and dividends? I will. Just stay back and I will throw more light on coupons and dividends. Sir, can we identify one CFD and the actual stock, also the likes of Trove and Bamboo? Are they actually selling CFD? By CFD, I think you mean contract for difference. That's currency. That's currency. Trove and Bamboo, I think they're just platforms where you can buy types of investments. I do not know if they trade currencies over. So CFDs are just currency pairs, more or less, where you buy the differences. The Jeez, man. Okay, can you differentiate between the types of companies in the US? LLC, S corp. LLC is what we call limited liability company here. S corp is just a corporation. It's just how many people are in the company when they first of all start. That's basically depends on an S corp on LLC. LLC just makes me limited liability corporation or company. Just the same way we call LLP limited here. That's what they call LLC. It's just a nomenclature difference within America and Nigeria. Who determines the percentage of shares of a company to be offered to the public? The company does, yeah? So the company can say, want to raise 1 billion and we'll sell 1 billion shares of 1 naira. Is there anything like percentage of equity of a company to be offered and what is the benchmark? No, it's the company that takes the decision of what shares or how much it can offer to the public. Yeah. Okay. uh, let's move on. Okay, guys. All right. So just want to get the next slide. Let's talk about bonds, guys. So let's talk about we've talked about equities. Let's talk about bonds. And bonds are a lot easier to understand than equities, yeah, but they're a bit more difficult to price. Let me say, because equities are simple. You buy into a company, you get a return. But a bond is more or less you are lending or you money to or you're giving the guy money, either the corporation or the government, to do a project or to finance their budget. And then they give you what's called an IOU. That IOU is your bond. So with a bond, more or less, the company is basically saying, we want to do this project or want you to borrow us money. We don't want to go to the bank. So you give them you give them your cash, they give you a piece of paper. That piece of paper is basically called a bond. It's the same thing with the government. The government borrows money from you and gives you a treasury bill or a federal government bond. That's basically what's called a bond. Yeah. So there are three main things you have to watch out for in bonds. The face value of the bond. So you normally see the bond will say this bond is for 1 million and is paying you 10%. That 10% is what's called the face value or the interest rate offered to you. It will never change. That 10% is what you would get paid throughout the life of the bond. So the 10% it will never change. The coupon, yeah, is now the return that is being paid to you. So that 10% is basically what is going to be paid to you per share, for instance, yeah, per share of your investment. So the face value is how much they want to raise. The coupon is basically the interest rate they're going to pay you. So just like the coupon you see tear off, normally bonds have all these tiny things you can tear off. That's how it was done in the past. But now when you buy a bond, the coupon means the return or the yield you are going to get back. This is where the problem is. Because the bond is going to give you the same return, whatever happens, the price of the bond then changes as interest rates change. I'll talk about that in the next slide, but just keep that in mind that the bond is going to pay you the same amount of money, whatever happens. If the economy is good, it pays you 10%. If the economy is bad, it pays you 10%. That's the bond. Then all bonds have a maturity date. So the bond could mature in 10 years, in 20 years. In Europe, they have 100-year bonds. In Nigeria, we have 91 day, 180 days, 365 days, 2-year, 5-year, 10-year, 20-year bonds, even 25-year bonds. So these are the three keys that the bond that you have to watch out for in the bond: the face value, the coupon, and then the maturity date. Yeah, the face value is how much they're borrowing. You want to borrow. The coupon is how much they're paying you for borrowing it to them, and then the date is basically how long they want to basically have your funds with them. Now, let me just touch this. I won't go too much into this. I don't want to confuse you guys too much. Yeah, the interest rates and the bond prices. The interest rates and the bond prices, they move like a seesaw. They are inverse. If the interest rates in the economy goes up, what's the interest rate in Nigeria? That's the NPR. that rate that the CBN publishes, that MPR rate, when the MPR rate goes up in price, what happens to the bonds price? The bonds price will go down in price. You don't worry if you don't know how. Just remember this is a rule. It doesn't change. If you don't know how, that's fine. But just know that when the interest rate of the economy goes up, the bond price will come down, right? So that means that when traders trade bond prices, they're trying to say, what will be the interest rate in 2 years? And then they try to take a position, either if the rates will go up or if the rates will come down, because that means that the prices of bonds will also go up and down. So I won't go too deep into it, but just for you to understand that what this means for you as an investor is this. When you are buying bonds, you are not too concerned. Don't be too concerned about the coupon. The coupon is going to be the same, but your real yield is called the yield to maturity, not the coupon. Because if the interest rates change, then the price of your bond will change, then your yield changes. So when you want to buy a bond, you should always ask the guy selling you the bond, what is the yield to maturity of this bond? Not the coupon. The coupon is what you see on the face of it. That will never change. But the real money or the real cost or the real income from that bond is going to be the yield to maturity. That's why I'm basically showing that here. So that's just for you as an investor. That's what you should be worried about. What is the yield to maturity of that bond? Yeah, don't want to go too deep into this. Yeah, okay. Now we're at a stop place here. This is like a new topic. So let me clear the questions I have, guys. Please bear with me. Let me just clear the questions. Okay, so can you differentiate between the types of companies? Yes, I've done that. Can you throw more light on coupons and dividends? So coupons and dividends are both returns that you make when you invest in either a bond or equity. Coupons are related to bonds and dividends are related to shares. So if you buy a bond, normally called the return they give to you your coupon. But when you buy equity, they call what's given to you the dividend, right? Okay, so that's done. Can one company be listed on more than one stock exchange? Yes. You can have Dangote listed in Nigeria and also in South Africa and also in London. You have, for instance, the oil company in Nigeria, Statoil, listed here in Nigeria and also in London. Yes, MTN is also listed. Remember MTN, they're listed here and of course in South Africa. Yes, so you can be listed in many exchanges. And what's the advantage? You can raise money on all those exchanges. How can shares be transferred? That is outside the scope of this topic. You want to transfer your shares, just see a stockbroker, yeah? And they can transfer your shares by selling it or transferring it on your behalf. Do you have a paid class? We have a paid class. Yeah. Does one have to sell their shares to make a profit when the share price appreciates, or can you take profit and leave your initial capital in case the price continues to rise? Yes. If you buy 10 shares for 10 naira, remember we saw Elon Musk. Elon Musk sold the first shares for about $17. Now they're about $800. So you can sell two and take your profit and leave the eight back in if that's going to be what you want to do. Yes, it's possible to just sell a bit one share and leave nine if you basically bought, say, 10. Yes, the answer is yes. Okay, someone said I just answer the whole lecture and then take the questions. There will be lots of questions. So that means you guys would have to wait till the end for me to take all the questions. So yes, I will just do the lecture and I'll come back to the questions. That would also help my chain of thought. So let's just go to the next slide if you guys do not mind. Yeah. The next slide I have here is the market terms. I just try to think of all the words that I think are going to be necessary or you guys would have to remember in this course. Buyers and sellers, that is easy. Brokers, that's easy. Those are stock brokers or bond brokers. You can basically guys you go to meet to buy your equities or your bond holdings. Right now, we even have fintech apps where you can buy your holdings via the telephone, you don't or the online, you don't have to basically go to a physical office. Rules of trading, yes, they will have rules of how you can buy shares, rules of listing, they are all in the market, and it's also a good idea for you to be conversant of them. Index, very, very important keyword, because the index basically means, if you look at on the TV, you hear them say the stock market went up in price yesterday. What they mean is that the index went up in price yesterday. What is the index? The index is all the shares listed on that particular trading platform. Let's take the Nigerian Stock Exchange or the New York Stock Exchange. All the shares listed on the New York Stock Exchange could be either, say, for instance, the S&P 500. That's all the top 500 shares as listed, the S&P 500. Then you have the Dow Jones. That's going to be the top 30 stocks. You have the Nigerian All Share Index, which is going to be all the shares listed in the Nigerian Stock Exchange. Those are indexes. Those are indexes. They capture a total number of shares either by type or by geography or just by location. And then when they say the market went up, they mean the shares in that index went up or down. So the index allows you to basically to track performance vis-a-vis listed securities. It also allows you to then invest. So if I want to invest in the US, for instance, and I don't know what share to buy, I could simply just buy the index by buying either all the stocks in the S&P 500 or all the stocks in the Dow or all the stocks in the technology sector. So the index allows me to basically track or to invest in a particular group of companies by location, by type, etc. Yeah. Let's talk about price discovery. Price discovery means if you're a private company, let's say, let me give you an example. You have a car in your house. What is that car worth? You don't know because you haven't tried to sell it. It's only when you try to sell your stock that you know the price. Same thing with the stock market. You might have a share of Nestle. You don't want to sell it, but you want to know what the price of Nestle is. So if you go to the stock market, you can see that someone just sold the share price of Nestle and has sold at this price. So it allows you to do what's called price discovery, to know what the price of your share is being offered or bid for on the stock market. So that's price discovery. That's one of the roles that stock markets play. What about opening and closing? So every day stock markets open, then they trade, then they close. So the stock could open at a price, but it's always the opening and the closing price that you basically then to see whether the market went up or the market went down. The capitalization, we've talked about that. That's the total number of issued shares that are fully paid up multiplied by the market price per share. So when a company is said to be a big company or what we call a blue chip company, all that means is that the company has a high price for the large number of shares that have been issued. Bulls and bears. What is the bull market? What is the bear market? A bull market, basically, I don't know where they got it from, but I think a bull market, no, the bull attacks by taking its head up. So that's a market that is going up. When the market is going up by 10, 20% or appreciating in price, that's what's called the bull market. A bear market is when the market is basically going down in price. And there are different types of bear markets. I'll talk about that later. So the bull market, the market is going up. The bear market, the market is going down. Bid and ask. So you want to buy a share, you bid for the share. Yeah. If there are too many bids or too many people want to buy shares, then the share price goes up. The stock market is just like any other market. If you go to the market where they sell Gary, it's the same thing. If you want to sell a lot of Gary and Gary comes into the market, then share prices will go down. If people want to buy more Gary, if people are bidding for more Gary, then the share price of Gary goes up. Same thing, no difference, right? Let's talk about the investor. What does the investor do first of all? The investor exchanges his cash for issued securities. He then becomes a shareholder or a bondholder. So if you buy for the first time, you're buying through the primary offer. That's why you say the primary offer. If you buy the shares the second time, i.e., the company can only sell its shares one in the primary market the first time. Once you buy that, then it goes to the stock markets for the secondary trades. Let me explain again. When Dangote sold his shares, the first time people bought those shares from him by offer of sale, that was a primary offer the first time. After that, all those shares then went to the stock market. So if I want to buy Dangote sugar, I don't go to Dangote anymore. I go to the stock market and I buy the shares from someone else that owns Dangote shares and wants to sell to me. The first time Dangote sells his shares in the primary offer, he, Dangote, the company, gets the money. But the second time in the secondary market, it's the seller and the buyer that gets the money. Yeah. So when you see that offer for sale, it's Dangote coming back to the market with more shares. So he's selling more from the company. That's why you see the offer for sale. But if it's just me as an investor selling, it's not an offer for sale. I just go to the market and I offer my shares and someone can buy from me. I take the money and I pay the other guy. There is no, Dangote is no longer involved in that secondary transaction that has taken place between that person and myself. Why do investors buy? Investors buy because they want to earn a return based on expectation of earnings. Why are people buying Tesla today? Because they expect or they believe that Tesla is going to make more money in future. So they are paying today with the expectation that tomorrow Tesla is going to make a lot of money and then they're going to basically be rich. Yeah, to earn a guaranteed return. Maybe someone has retired and he doesn't want to invest, he doesn't know too much about investing, so he wants to give his money to someone to then pay himself an annuity, for instance. So he wants a guaranteed return. He doesn't want any stories. So he can buy a federal government bond. He can buy a bond issued by a private company. I think I have an example here by Afrinvest where you can simply just give them and they give you back. And he wants to get a stream of income that is not fixed and thus rises with economic growth. So the guy can say, hey, I want to invest because the income or the interest rate that the banks are paying me or the government is paying me is so low that it's not beating inflation. So I want to invest somewhere else. I want to maybe buy shares that will then give me a higher rate of return than what the government is giving me or what the private sector is giving me. So he wants to get a stream of income higher than what the players are giving to him. That's why he's basically buying. Yeah, fixed income securities are below inflation or just too low. That's basically the point I'm making. Right now, we all know what federal government bonds are doing. Very, very low, almost below 1%. So an investor is basically buying other instruments, other currencies, other locations. We're going outside Nigeria now to buy foreign stocks because the returns in Nigeria are low. That's basically why investors are basically buying Bitcoin and all that kind of stuff because really the investment returns here are very, very low. So we're trying to take more risk by going outside our comfort zone and then buying. Of course, we want to hedge and diversify. What do I mean by this? Where you are earning in Nigeria, especially in say Naira, and the dollar rate is basically going up. You might say, well, I want to basically diversify my income stream. Maybe I want to have a dollar return. So that way, I'm not just earning Naira, I'm not caught up in the falling Naira. If I want to save money, probably I'll save in another currency. So that way I can perhaps have a store of value of my assets. So investors that basically have all these considerations, they want to make money, they also want to store their money. They want to avoid inflation. They want to ensure their money can be given back to them in the future at an inflation adjusted real rate of return. So all these considerations are going on in the heads of investors, and then they're then trying to make investment decisions in the marketplace. And it's because we have so many of this going on that sometimes we make mistakes and we are also emotional. We do not take an academic look at investment before we then put our monies down. Yeah. So let me give you guys an example. Like, look at this, the Afrinvest Dollar Fund. If you look at what I've said here, he's hedging and diversifying. So these guys are basically saying, hey, if you are in Nigeria, you can invest in US dollars from like $1,000 here in Nigeria. and then they are able to then give you returns in naira, in dollar terms, I mean. So this is a way that you can say, hey, I have some money, I don't need it today, I need it in say 2 or 3 years. I just want to get that money back at the same value today. I know there's inflation in dollars, but at least it's not as high as inflation in naira. So you can say you want to do something like this that would then invest in a foreign currency. That gives you diversification. That hedges your asset base or your cash flow away from just one currency. These are the kind of sort of things that investors could decide to do. Yeah. Okay, now let's bring everything we've spoken about into this one chart, yeah? And I try to put everything here. We've talked about the companies, the corporates, the banks, and this chart is basically telling us this is the primary market, yeah? So primary means the first time the company is selling either its bonds or its shares, right? So you can see if it's the primary market, the corporate is going to be the company, and the corporate is going to sell its bond or shares to who? To the institution, which are going to be like when we saw the Dangote and even the Tesla, we saw all those banks and those companies listed under those companies. Those are what I call the issuing houses or the investment banks that sponsor that transaction to the marketplace. So the company, the corporate, is selling its bonds or shares to the underwriters. And then the underwriters is distributing those shares to you, the investors. So you, the investor, give the institutions your funds. Your institutions takes all your funds by way of capital and gives it back to the corporate, right? Then you have the banks. You can see where they sell side and buy side, right? So the investment banks are those companies you saw, those banks you saw. They basically go to the corporate and say, hey, why don't you, have you guys thought about issuing shares? Right now, issuing shares are very, very good because maybe interest rates are very, very low. People are looking for a way to buy into higher yielding investments. So if you guys sold shares, you might get a better reception out there. So the corporate says, okay, yeah, we'll work with you. And then they then issue shares. And the company takes those shares and then sells it to institutions or what we call the issuing houses who then offer it to you guys. You guys invest, the money then goes back to the corporate. This is basically a summarization of basically how that occurs in the marketplace, more or less. Yeah. So let's now talk about asset class behavior. And this is a word I want you guys to get comfortable with, asset classes. So asset classes are basically when we say bonds, equities, commodities, those are all different assets and then there are classes. So that's how we group them. So like this, like saying what are the characteristics of different asset classes? How do they behave? Because if we understand how they behave, it allows us to invest better, right? If we understand how they behave, we can then invest better. Okay, so the first thing here is why do shares rise and fall? Why do share prices go up? Why do share prices come down? The answer is simple. It's all about demand. So the rising, stable, falling. Rising market is when we have a bull market, right? So when it's a bull market, what does that mean? That means there's a lot of demand for shares. So you can see the demand triangle is larger than the supply triangle. When demand is more than the supply, the price is going to go up. The same thing like you have in any market. Once the price the demand is up, the price will go up. No, it's the same with Bitcoin, with shares, with bonds, with gold. No, this is a universal law. At a point, demand and supply then meet themselves. So the price then basically stays stable. If you want to buy, there's a willing seller. If you want to sell, there's a willing buyer. So it's that no one can influence the market per se. So the market just more or less flat lines, yeah? Then, when there is excessive supply than demand, then the share price starts to fall. So, when people want the shares, the price is going to go up. When investors do not want the shares anymore, the price is going to come down, right? So it's easy. Demand and supply makes share prices go up and down. The problem or the question is now what drives demand and supply? That's basically the million dollar question because if you know what drives demand and supply, then you can make a lot of money. But because we cannot tell with certainty what makes demand and supply, we can guess, we can calculate, and the guys that do that very well are the guys that you see make a lot of money on the market, right? So I'm trying to answer that question here. Why does supply increase? Well, if security prices go up. If the company issues more shares, for instance, then there's more supply. If more people want to sell their shares, there's more supply. That's basically supply. So right now you see Tesla's price is going up. Why? Because there's a lot of demand for Tesla's stock. So people want to buy Tesla and the supply, nobody is selling per se. So the price is going up and up and up and up and up. If Tesla tomorrow says, hey, I'm going to issue 1 billion new shares, the price will come down. Unless if the demand is more than the billion, then the price will still stay up. You get the point? So if companies issue more shares, the price will tend to go down because the company is increasing the supply of shares in the marketplace. So that's one reason why supply goes up. Yeah. What about demand? The company is buying back her own shares. Somebody asked about the Dangote buyback. That's why Dangote was buying back his shares. Because when Dangote buys back his shares, he reduces the supply of shares in the market. And when he reduces the supply of shares in the market, what happens to the price of Dangote stocks? It's going to go up. That's why companies buy back their shares to reduce the number of shares in the marketplace and then make the share price to go up. If the company has a great result, people want to buy. Tesla is doing very well in China. People doing is sending stuff to space. Everyone thinks it's a genius, so everyone is buying. The industrial sector is booming. Zoom is booming. Peloton is booming. Anything to do with the internet in the age of the COVID is booming. So all the share price is in high demand. So the share price goes up, right? The US economy, even in the COVID, is also rising up because of technology. They have Facebook, Amazon, um, Google. Those are America is the only company I think with those five behemoths just there in that one stock market. That's why they said the market in the US is basically rising. If you remove the tech companies, the US market is just like the Nigerian or the European market. But when you have Facebook, you've got Google, you've got Amazon, you've got Netflix in there, that's in any market, that's going to cause a demand and it's going to cause the share price to go up. So just to recap, share prices rise when there's demand, they fall when there's supply. The question is, how do we know when there's demand and how do we know when there's supply? It's difficult to tell. And those that can tell are the guys that you see make a lot of money. So this is, I want to talk about this. We talked about the bear market being when the market is seeing the falling prices. And I want to just talk about, there are some words that you must have know, the correction and the bear market. Yeah. The correction, as you can see, the market started off, it was going up, it was going up. That was a bull market. Then the market fell in price. You can see it there. Let me get my pointer. So right here, you see the bull market, the share price is going up, going up, going up, and then the market price falls here. Because this fall is more than 10%, but less than 20%, we call it a correction, yeah? So then the market started to go back up against the bull market, then it fell again here. And because this fall, again, was more than 10%, but less than 20%, we all call it a correction. But what about here? When the market had this big bull market run from, say, to 2018 all the way till 2019, 2020, then here, after the elections, after COVID, oh, it came all the way down here. Now, this is also a correction, but because this correction is more than 20%, we then call it a bear market. So it has to start off as a correction before it gets to a bear market by the percentage fall in the index. So what's falling is the index, the index of the company, of the share in the index is basically falling. Hence, we then say it's a bear market or a bull market. Just wanted you guys to get the differentiation between those two points, yeah? Okay, so the next chart is going to be valuation. Remember, we've said that companies' share prices go up and down based off demand and supply. So the question is now, what causes demand to go up? What causes supply to go up? This is what valuation is trying to answer. Valuation is trying to say, to predict what will be the share price of the company in future. And if you can do that share price, then the companies can then know if it is cheaper today or expensive today. Now, the first thing to remember is that price and value in the market are not the same thing. Yeah, the share price is simply what is the share is being sold on the market. It has no correspondence with the value of of the stock. The same way, if you have beans and you have beans harvest, what happens to the price of beans? It will go down because supply has gone down. But the value of beans as a protein doesn't change. The value is still the same, but the price goes up and down. It's the same thing with stocks. So the price itself does not tell you anything other than that is the price discovery or how much someone wants to buy your stock from you. The price and the value are two different features. So the intrinsic value is really the real value or the inherent value in that stock, the value that represents the returns, the future returns of that stock, the stock we can measure, the real present value of the future earnings. That's what the intrinsic value really is of the stock. That's the real price of the stock, right? The market price is just what people want to pay for each stock. So two differentiations here, yeah? And the relationship between the intrinsic value and the market value is represented somewhat like this graph right here. So you see the share price going up and down. So the share price or the market value is going to keep on going up. Whenever the share price, as you can see on my pointer, you see here, this is overpriced. Why is it overpriced? Because the market value is basically higher than the intrinsic value. So the share, we call it that the share price is now overpriced. When we say it's on the price, that means that the share price is basically selling at a lower price than the intrinsic value. So when the stock is underpriced, it's the buy. People want to buy because then it will go back up. But when the share price is overpriced, then it's going to fall because people are going to say, hey, it's going to eventually fall. So the question now is this: is Tesla overpriced or underpriced? Is Tesla overpriced or underpriced? No one can tell you that. People will write and say it's this or it's that. But the point is that we do not know because we do not know the profits Tesla is going to make in the future. We can estimate. We can say based on their past figures. We can say based on the price earnings. We can say based on earnings. We can say all that. But ultimately, this line here, you see the intrinsic value line, is tracking real fundamentals. And we can only say Tesla is overvalued or undervalued if we can know what the real intrinsic value is. There are calculations for the intrinsic value, but it's still a guesstimation because no one can really tell you with certainty. So stock buying is basically you determining what the intrinsic value is. And then if you have that value, if any stock is higher than your intrinsic value, you sell it. If any stock is lower than your intrinsic value, then you buy. This is basically if you want to understand stock trading, this one graph is basically all you need to understand. Intrinsic value, market value, and of course the timing. And you can see intrinsic value is more stable while the market price goes up and down. You want to ask yourself, yeah? I'll give an example. So let's look for a nice example. Let's say Boeing. No, let's say Starbucks. Yeah, when Starbucks, an MD of Starbucks, let's say a guy in Starbucks had an issue, maybe a racial issue. People came into Starbucks to use the bathroom, and they said, "Oh, don't use the bathroom," and it caused a big PR mess. What will happen to the share price of Starbucks based on that issue? Yeah, it will fall because people will say, well, will this affect earnings? If it will affect earnings, then the share price will fall. But somebody else will say, I don't think it will affect earnings. Yes, it's bad news for Starbucks, but will it affect earnings? I don't think so. So the guy will keep his own share price up above here. But the intrinsic value of Starbucks does not really take those short-term issues into consideration the way the traders do. The intrinsic value is going to be based off the sales of coffee, the brand valuation, the cash on hand. So it's going to be a bet to say, hey, if I think that issue will affect Starbucks a lot, the share price will then be affected and it will affect earnings, then I'm going to reduce their share price here and sell. So if I reduce their share price into the future, then it's overpriced because right now it's overpriced. But if I think that it will not affect Starbucks in the future and I plot my line, that means that today it's underpriced. So I'll buy. So you can see it's a guesstimation. You can really not tell because you are saying it would affect, the other guy is saying it will not affect, and both of you can be right. There's no right answer. So it's based off your experience, based off your guts, based off your calculation that you want to basically reach a conclusion, which might be right or wrong. So it's a good way to look at the market that everyone on the TV is not exactly right. No one can tell you for a fact what the intrinsic value is. Remember what I said, you can calculate it. You can actually get a number for an intrinsic value, but it's all based on an assumption, which could be correct or wrong. Which leads us to what we call the analysis, how we then try to calculate all that intrinsic value and all. And there are two ways. So you got the guys that do the technical side, the technical analysis. They use the price charts, they use indicators, they use oscillators. They are trying to basically say, based off the movement of the prices, we believe that this price is overpriced or undervalued, or they believe that it's going to rise in price tomorrow, or it's going to go and fall in price tomorrow. The fundamental guys, these guys over here, are looking at the analysis of the company, the industry, the macroeconomic outlook, the future profits. So they are basically looking at the naira and kobo, the dollars and cents, the market share, the price and ratio, stuff like that. These guys, the technologists, are looking at the rise and fall in the pricing. And they're trying to say tomorrow is really based off what the stock has done yesterday, more or less. And both you could say both have their own merits and demerits, but this is basically the two big schools of analysis. Are you a fundamental guy or you're a technical guy? Which do you really use? And if I give you guys an example, so the technical guys are evaluating investments to identify trading opportunities using the trend. So it's more or less the trend. They're looking at what the trend is. If Bitcoin is going up, will the trend continue? Does it give you a head? Does it give you a shoulder? They have all these terms that they use to basically say, based on the chart that we're looking at, we think that the price is going to keep on going up. And if you go back to our chart, if the price is going up, that means that the demand is also going to be strong. So they are trying to decipher demand also by looking at charts and the daily price movement and then taking a position right ahead of time. And that's what they're basically doing with stuff like this. So they tell you, hey, this is a bullish trend. You can see the bullish trend, the stocks are basically going up. So the green means the stocks are going up. The red means the stock's price came down. But if you look, they've drawn their line and they basically said, hey, you see, this is the average movement here. The stock has been going up. So this is a bullish trend. Then you see the stock price then came down here and went up. So this is a double bottom, 1, 2. The double bottom came here. So now they're basically saying, hey, this is a bearish trend because this trend line is basically trending down. Then they've drawn another line here. They have all these names, the hammer, reverse candle, bullish trend, you see. So by them looking at this chart, they can tell you, hey, I can see a head and shoulders here. I can see a reverse hammer candle here. This tells me that this was a breakout session right here. And then the stock price then had another bull session here. They are basically telling you that they can tell you what will happen here by looking at what has happened here. That's what the technical guys try to do. They try to basically forecast what will happen in the future here by looking at what has happened in the past here, by looking at the trends in the movement of the share prices. So this is your basically technical analysis, yeah? What about fundamental analysis? These guys are trying to look at the sales, the revenues, the earnings, PL, cash flow. They're trying to look at the nairas and kobo. They're trying to basically do what's called get the present value of the future returns and bring it back to today. That's basically what they're trying to do. They're trying to basically say, hey, we want to basically get the present value of all the future expectations or the future income flows and bring it back till today. That's what they're trying to do here. So they are different in terms. They don't look at the charts per se. What they're trying to say, if the companies had a PE ratio of X yesterday, we think it's going to do PE of X today. Of the company's market share is X, we think that it then generate prices of this and then post the revenue of that. So two different schools of thought, but they are all trying to do the same thing. They are all trying to determine demand or future share price. Because they get a future share price, they can determine if demand is going to be strong or if demand is going to be weak. That's basically what they're trying to do. If you know where the market is going to be tomorrow, then you can take a position today and make a lot of money. That's really what it is all about. Yeah. So we've done all that. We've done a lot, guys. I've summarized a lot, but we've covered a lot. At least that gives you an idea of what equity and debt is. You know what some asset classes is. You know how companies sell shares, primary markets, secondary markets. You have an idea of inflation. You have an idea of bonds. Those are in your head and they swim in your head. I don't give it too much information. So this is really what I wanted to do today, to talk about how to build a portfolio. But I couldn't do this without first of all giving you guys all that initial, introduction to investing. So let's now talk about building a portfolio, because now we're in 2021, we're in January, we have tons of opportunities ahead of us. How do you build a portfolio to then take advantage of what's ahead of you? That's what I want to talk about today, right? So first things first, we have to understand how to invest, because they're investing styles. So we have to know how people invest and see if we can copy them and make it better, or just copy what they're doing. Yeah. There are again two schools of thought of investing. There's value investing and then there's growth investing. With value investing, it's like the name says, you are trying to buy value. So you're trying to buy a good stock at a low price. That's really what value investing is. You're trying to buy a good investment. You're trying to buy a Tesla at a lower price when it falls, more or less. And then the guy that does it the most is, you can say, maybe Warren Buffett. Yeah. And I give you an example. No, Warren Buffett took 1.3 billion and he bought 400 million shares of Coca-Cola, and now those guys are basically worth about 21 billion, more or less. So he's Coca-Cola was a big company already when he bought into when Warren bought into Coca-Cola, but Warren bought them at a cheap price, i.e. he value invested and bought a good company at a cheap price, and they simply waited for the valuations to then catch up to the price, and then he makes money. So that's value investing. But growth investing is different. Growth investing is, you're trying to buy into into a company that's going to grow. And maybe the company might be an unknown. A company could be a Zoom. So you're basically trying to say, hey, what are going to be the growth sectors in the economy going forward? And how can I then latch onto them? How can I identify them and latch onto them? Whilst the value guys are talking about price to book, which is, you're trying to say, is that what's the asset cost? Is it cheaper than the market cost? Or what's the margin of safety? You're trying to see, I know this company is good, but I want to buy it at a good price. You're trying to say, I'm looking for Messi, but I want to buy Messi when he's 10 years old, not when he's 20 years old. That's what value investing is. You want to buy that good company. You know your company is good. You know Messi is good, but you want to buy Messi when he maybe has an injury, or when he's not scoring goals and he's playing on the sub bench. Then you want to go buy him then. You know he's good, but right now he's just in a bad state. So you go buy Messi when he's maybe in a bad state. But the growth guys are saying, no, we don't want to buy Messi when he's Messi, when people know him. We want to buy Messi when he's still a 5-year-old boy, when nobody knows him. We want to invest in him today, because in 10 years he's going to be Messi. We don't want to buy him when he's known. We want to buy him when it's unknown. So you go buy the Zoom, you go buy the Tesla when it was $17 way back. So you're looking at the forward earnings, future potential. So you have to say, are you going to be a value investor, or are you going to be a growth investor? That's going to be the two things you're going to ask yourself. Do I basically want to be value, or do I want to be growth? That's what you want to ask yourself. Yeah. And if you don't want to do either value or growth, you basically want to ask yourself, how do I want to trade? This is now trading. It's more like how you want to go in and out of your portfolio. Is it going to be position trading? Are you going to do swing, or are you going to do day trading? The difference is, as you go down the list, your investment duration is reducing. If you are doing day trading, the last guy there, you are trading more or less very, very quickly. You are doing almost 4 trades a day. You are opening trades, closing trades, 4 days trades a day. With swing trading, you are more or less not doing per day, but you're basically looking for momentum that is a bit longer. So you are saying, okay, I'm going to take a position today and exit in a week or in 3 days. But in position, this is basically where the guy takes a position and then waits for the market to catch up. You might say, okay, right now the economy is very, very bad and housing is doing very, very bad. I'm going to go buy housing and I'll wait for 3 years. That's basically what the position guys do. That's what those guys are doing. That's what someone like Warren Buffett will do. He's going to go buy those sectors that are doing very, very bad today and just wait. Yeah. All right. So same thing I put in here. Yeah. So the best practice for you to invest is, of course, do your research, analyze using fundamental or technical, have a plan, diversify, stay invested, and of course, have no emotions when you're investing. Don't invest, don't buy your friend's company because it's your friend. If it's not paying well, don't buy it. Yeah. So I mean, these are things you can expatiate, but they are self-explanatory. Okay, so I had this here, but I don't think we have the time to do this. Maybe we'll do this on a different Zoom meeting, but just to explain how the stock tables, what they actually mean. We'll try to do it another time. I don't think we have time to go into this today. So now we are at the building a portfolio, right? The first thing I want to show you guys is this chart right here. So this chart is basically showing you asset classes. I've tried to do asset classes, but I've tried to do them by risk and return. So on the left-hand side, you have the less risky investments. As you go down to this side, you have the more risky investments. Yeah. So these are like any asset you want to buy is basically going to fall into this spectrum. If you have cash, there's no risk if you hold cash, but the cash can lose value. Imagine if you are holding Naira for 2019 to 2020, you've lost money. Yes, you've not invested anywhere. Your money is under your pillow, but you've lost money because of inflation. So it's safe, but it's lower risk, but lower return. What about treasury bills? Yes, it's safe and you get a bit of return, but it's still lower return, but lower risk. Now, what about corporate bonds? There are some corporate bonds that are out today with 6%, 7%, some with 12%. So yeah, you are getting a much, much higher risk, but you're getting a higher return as well. Same thing with municipal bonds. These are like states or local government bonds. They are riskier than government bonds. So yes, you're going to get a higher rate of return, but you're taking on more risk. Then large capitalizations like the blue chip, the Dangotes or the Teslas. They are risky. They give you there's a large risk there, but they give you a high return. Look at REITs. These are property, real estate investment trust. This is property. Who is buying property now in COVID when everybody's at home? So basically, it's very, very high risk, but you get money. Look at mid cap value stocks, pennies. These are like the penny stocks are going to be your startups. Zoom used to be a penny stock before COVID. Tesla also used to be in this area here. Maybe value stock and all that before everything started. So really, when you look at this chart, what it's telling you is this: if you want to invest, you want to ask yourself, do you want risk or do you want return? You can't have them both. You can't put all your money in cash because you will lose your money through inflation. You also can't put all your money in penny stocks because you might just lose all your money as well. So it's going to be a blend of this whole chart. You have to take some risk and take some return and then try to blend it according to how you define risk and your own objectives. There is no better investment. It's just how you blend it. That's the point of this. It's just how you blend that investment to then give you a return in future. Yeah. You have to have a plan. 5 year, 10 year, 15 years. It could be 1 year, 2 year, 10 years, but you have to have a plan. You have to say, by 5 years, I want to invest in these asset classes. And as I get to 15 years, I want to diversify away because I don't have to take all that risk anymore. Very important. Yeah. So before you invest, this is the questions you have to ask yourself. Remember that we've talked about you cannot invest all in no risk securities. And we also said you cannot invest in high risk securities. So you want to basically ask yourself these 4 questions. What is your objective? And you can't just have one objective. It's going to be a blend. You say, okay, my main objective is going to be appreciation. That's going to be the main thing. Doesn't mean I won't preserve, but that's going to be my main thing. What is your risk profile? How much risk can you accommodate? What about your duration? How long are you investing for? 3 months, 2 years? And of course, your age. Your age, the number three and number four are almost the same question, but we try to separate them because, yeah, it does have a meaning when it's separated to the advisor. So you have to basically have answers to these four questions before you invest. You can't invest for returns. You have to invest for objectives. So you must invest to meet your own objectives. You can't simply invest for returns. So you have to, as we said, understand this chart, ask yourself these questions, and then basically answer them yourself. So I've done this for you guys. This is something I've done real easy. So like a decision tree, start from the top here. When do you need your money? Do you need your money within 2 years? You can make this 1 year. You can make it anything you want. Do you need your money within 2 years? I ask. If you need your cash within 2 years, yes, then don't even look at shares. Don't even look at shares or options or commodities. Just leave them alone. And we come straight to fixed income, which is this guy's right here, which I think is going to be the next chart here. So let me go back so you guys see what I'm doing. Do you need your money in less than 2 years? If the answer is yes, then we just move here. This chart you see is this chart here. This savings, money market, treasury bills, that's basically this. So if you're going to want your money in less than 2 years, then we're coming here. So if you say you want your cash anytime, you want a savings account or call deposit. What's the advantage? You can get your money anytime. What's its advantage? No returns. You want your money like 30 days, then you do fixed deposit or secure deposits. You want your money in 24 months, so you want the money in 2 years to 3 years, yes, do federal government bonds. You want your money longer than 5 years, do federal government bonds or corporate bonds. So you get a higher return, but see how long it is, right? So all these questions is basically you are answering the question yourself. If you say you want your money in less than 2 years, then you shouldn't go more than a savings account or fixed deposit. There's no point saying I want my money in 2 years, but I want to make a high return. It's not possible. You are giving two conflicting answers. What if you want your money, you don't want your money more than 2 years? Okay, that means we can then proceed to the right-hand side. But what's your risk level? If it's low, then you want to do blue chip bonds, blue chip stocks, sorry. Even property, you want to do blue chip property. You want to do high yield bonds. What if it's medium? Maybe you're a medium guy. Maybe you can take some risks, but not too much. Okay, you can do an aggressive equity fund. Maybe you want to invest in a mutual fund that invests in shares. You can buy an ETF, for instance. But what if your risk level is high? Yeah, then you want to do options, futures, commodities, private equity, and all that kind of stuff. So this is a good way to invest, just asking simple questions. There is you can't say if you want your money back in 1 year, then you cannot invest in shares. You shouldn't, because the share might be going down by the time you want your money back. That's the point I'm trying to make. So the question is, how can you then arrange that information into a portfolio? So this helps you say, okay, it clarifies your thoughts for you. If you can make this 1 year, it doesn't matter, and say, if I want money back in 1 year, you are doing fixed income. If you want your money back in more than 1 year, you are going to do more of variable income, because these guys need time to make a return for you. They need time. If you look at Tesla did not get to $800 in 1 day, right? It took some time. Even Bitcoin took some time before it got to where it is today. So this is more risk, but it does carry a reward. Not all the time. You can lose all your money here when the risk level, if you invest your money in blue chip equities, you can lose all your money. Enron was a blue chip, it crashed. Same thing with options. But if you invest your money in treasury bills, you will lose your money, but you may not beat inflation. So it's going to be a blend of everything, right? Okay. And this chart we said was just the left-hand side of this. So we're basically saying we broke down this money market into these guys right here. And we said savings account, fixed deposits, CDs, and bonds. So these are all fixed deposits. These are all safe. So they are safe. They might not beat inflation, but they are safe. So if you want safety, you come here, right? And then I try to give you guys an example. So like this is the AfriInvest Plotters Fund. This is a money market fund, yeah? So if you want to do a money market fund, that means you're basically saying, okay, I want to have this. I want to have all these guys apart from this bond. This bond is long term. This is more like 5 years. So if you want to do savings, fixed deposits, CDs, maybe some savings bonds, some commercial paper. This is a good investment for you because these money market funds, they have money market equity funds. They then invest in that pool. It's like an index or so. They buy money market funds. Money market is going to be short-term funds. So you just buy this guy and then you are exposed more or less to these guys right here. That's why I put that example in there for you guys to see. So that's basically how you do it. If you then say you want to do equity, you then go buy an equity fund or you buy the individual equities per se. This is basically what you want to do, right? But look what I've done here. I've also tried to do the same thing to say, okay, what if the guy is saying, yes, but I want to blend it out. I want to blend out my investments. I just don't want to basically be all in equities or to be all in bonds and all that. So I've tried to say, okay, this guy is, let's go back. This guy is aggressive. This guy is moderate. This guy is conservative. So we're basically saying how their investing styles. So you can see here, the aggressive guy has absolutely no cash. Let me take this off. The aggressive guy has absolutely, if you look here, this guy has got 30% in cash here. This guy is saying no, his full equities. His equity is 50%. Let me put my. So because he's aggressive, he's basically saying my equity portion is going to be 50%. Then this is 20. This is going to be like mid cap and then low cap here, right here. But this guy is conservative. So he's saying he's going to have about 30% in fixed income. So what's going on is this, as he's getting older, this is when he's a very, very young guy, 10 years, he has more than 10 years to retirement. He can afford to take risks. So he's doing 50% in equities. But as he's getting older, he's reducing these equities from 50% to 15%. So in this way, this guy is basically saying, not only am I not going to take risk, as I'm getting older, as I'm older, I might not have enough time to recoup my investment. I'll reduce the risk in my portfolio by reducing my equities. That's basically what this guy has done here by taking this 50 to this guy here and introducing 10% cash or bonds and 20% cash or bonds here. So the point I'm trying to get across is this. You can't invest because of returns. You can't say when you are 60 years old and about to retire that you put the bulk of your money in Bitcoin. It's making a lot of money right now, but we do not know what's going to happen tomorrow, and nobody can tell you what's going to happen tomorrow. It can get to 100,000 tomorrow. It can get to 10,000 tomorrow. So the point is, you should buy a bit. Like this guy is buying 15%. He's saying, yes, I'm still going to do 50% in risk, but he cannot put 50% of his money in that asset class, because if he loses that asset class, he's already 60. He can't go to work anymore. He's basically at the end of his career. So you have to invest with that in mind. The same thing we did in the first chart where we showed if you want your money back in 1 year. So in that instance, even though he was a young person, if that was his rent money, if you put his rent money in an asset that he's not sure of getting it back, he might not have a house next year to when the rent time comes. He might have 2 houses, or he might not have a house. You don't know. Here's the point. So that's the way to approach investing. If you know the asset classes, then you build out a portfolio more or less to meet your own objectives, not someone else's objective, to meet your own objective. You can say, I don't take any risk. I will take inflation. That's fine. and you simply be all in that investment. You don't have to build anybody, you just have to build yours. Yeah, that's what basically what we're trying to just show here. And the next chart is just going to show. I'll try to then do the final one. These are stuff I talk about a lot on Twitter. But if you were trying to then build a portfolio, you didn't know anything about investing. You just want to build a portfolio, especially a foreign portfolio. You said, hey, man, I want to diversify my portfolio. This is something you can do, right? There's equities and there's bonds. We've talked about equities are more or less lower risk, and bonds are lower risk, equities are mostly higher risk. Okay, so what should you buy? This Vanguard guy right here, this VTI, these are ETFs. So they are called exchange traded funds. They are basically like mutual funds, but they can trade them during the day. Just give me similar like mutual funds, or we say unit trusts, like we say in Nigeria. So what these guys are basically, if you buy this VTI, you're buying all the shares listed in America. So this company is called Vanguard. They basically buy all the shares. So this is an index that includes all the shares, total index fund of all the shares in America. What about this guy? This is the Vanguard Total International. So it's Vanguard minus US, VXUS. So they are going to buy all the shares in the world minus US. And this guy gives you all the shares in the world with the US. So you see it there. Same thing with the bond here. Vanguard is going to buy you all the bonds in the US, and here all the bonds in the world minus the US. Just four guys alone gives you all the bonds and all the equity in the entire world, more or less, that are good. So if you just say I'm going to buy 20, 20, 20, 20, or 25, 25, 25, you bought everything in the whole world. That's it. So the question for you is to come and say, okay, I might buy 15, 15, 30, 30. So you can increase your ETF here to 30, here to 30, i.e. your BTI 30, VXUS 30, BND 15, BNDX 15. So that way you've balanced out that portfolio based on your age, based on your objective, and based on how you view risk. This is how you want to approach investing, right? I'm not talking about the individual shares. That is a bit more technical. Like I say, you have to go analyze that, what you're doing. But this allows you to basically give your money to somebody else. Vanguard has been in business for decades. They can manage your money for you, and you just buy this for according to your proportion, and that's it. Yeah. All right, guys, we're almost at the end. This is all I want you guys to do. Like I said, thanks for listening. I'm going to take tons of questions right now. So subscribe to the podcast if you can. Like I said, the podcast, the way I see it, that's what I do every week. We try to break down complex stuff to really make it simple for you guys to follow. It's on everywhere, Google, Apple, everywhere you can get podcasts, you can get it. Join the Telegram group. We have a Telegram group, just guys there talking, asking questions, helping ourselves and answering. And of course, follow on Facebook, yeah? So we spent a lot of time. Thanks you guys for staying. I see a high number still stayed participants here. Thank you guys. Yeah, I'll close it out now. I'm done with the lectures. I am now going to go into the questions and take them one by one. And again, everything plus the questions are going to be recorded and I'm going to share them. So that's fine. If you want to leave, you can leave. You still get to hear all the questions and all the answers. But I'm basically done per se with the actual presentation, and I'm just going to go ahead and take the questions. Thank you for staying. Yeah. Okay. So someone's asking, how does a company determine the quality or value of its shares? Also, can a company continue to put up shares for sale? Is the limit? So first question, how does a company determine the quality or value? The company has no more business determining the quality of the value of the shares once it sells the shares, because those shares are now in the market. That's what we then call price discovery. It is the investors that will then give a verdict on the share price going forward. So once Dangote sells the shares, it's the investor that will tell Dangote, we like your shares, we don't like your shares, by buying or selling the shares, right? So that's basically that answer. Can a company continue to put up shares for sale? Yes, if the company can keep on creating shares for sale. But remember, the more shares you create, the more you are increasing supply. What do we say about supply? The more supply you do, the more the price falls. When the company issues too much shares, even if it's a good share, a good company, I mean, the company's share price will start to go down because it's too much supply. Thanks, Nene. Please explain bond holders get a mandatory fixed coupon. Yes, so if you buy a bond or if you lend money to the company or to a company, they must pay you that coupon. Unlike a dividend where they can decide not to pay, even if they have money. In a bond, they must pay, even if they don't have money. They have to go sell something and pay you. Otherwise, you can declare them bankrupt. So, Lushala, yes, if you buy a bond, you must get a mandatory fixed coupon. But the problem is that if the company does very, very well, you are going to get that same coupon. You can't ask for an increase in your coupon. Yeah. Okay. Will you be taking us through stepwise of investing in a name company? Is that will I take you step by step to invest in a company? I prefer you buy the ETF. If you haven't bought a company stock before, I prefer you buy the index to start off with, understand how it goes first of all, before you buy the individual share. Just to get into the market for the first time, buy the ETF. It's cheaper, it's diversified. Then you can start to then say, okay, I'm going to buy my favorite company, favorite stock. But it's your call. It's your call. But I try not to give advice in that way. Yeah. What's the most important indices to look for before you buy a share? So, what is a share? A share is just a share of the company. So, when you buy a share, you are really buying the company, right? So, what's the most important thing the company must deliver? It's going to be earnings. The company can say it's made profit or loss. It's cash earnings really that you are interested in, because as an investor, you want to get your dividends paid back to you, or you want the share price to go up. And that can only happen if the company is making earnings. Tesla is only going up in price because the company is making earnings. They are in China, they are sending rockets to the ship, so NASA is paying them, they're making cash. There was a time they didn't have any cash and the company nearly went bankrupt. But now people are buying because they believe that the earnings of the future for Tesla are going to be more than the earnings today. We don't know if they are right or wrong, but that's why they are buying. So I would say the most important indices I would look at for me is the cash flow. Is the company creating or generating operational cash flow from its operations? Operational cash flow, not cash flow from borrowings, but cash flow from operations. That's what I would look for if I was looking for one indices. How can a rookie get to invest in stocks and bonds? I would say if you're a rookie, start with reading up, doing your research, and then try to buy ETFs or unit funds first so that you can get a feel of a diversified market. Then do a lot of reading, start to watch the business news, go and get on business Twitter and all that kind of stuff. Get acquainted with it before you start to then invest big sums of money, right? So I mean, if you are busy and you can't run around stockbroking firms, I mean, get a fintech app. I use Trove. I use Robinhood. Open a Trove account. Buy the stocks. It's very, very easy for you to get that done, Yusuf. Yeah. What's the difference between a common and a preferred stock? Great question. So a common stock is just a stock. It's just common. But the preferred stock, okay, a common stock says you get your dividends if the company wants to give you a dividend. But the preferred stock, they have to give you a dividend. So the preferred stock is like it's like a hybrid between a bond and equity. So in the preferred stock, it's a stock that you basically get a fixed guaranteed return, but you have ownership as well. So it's called the preferred because you are a bit higher than the common stock guys. You are getting that the company has got to pay you a dividend. It is not like a common stock where the company can say, hey, we're not going to pay you. So the main difference between common and preferred is that the preferred guys get a guaranteed dividend return on that investment, and the common guys may not get, yeah, unless the company says otherwise. Hello, I own some Dangote cement. Dangote recently offered a buyback, but I haven't noticed anything happen since it was initiated. That's because the company or the market already priced in the Dangote share buyback into the price. So that high price you see on Dangote cement is already pricing in the share buyback. When the company does the share buyback, the share price goes up. If you look at Dangote's share price before they announced the share buyback, it was less than that. So that's what's going on. The market has already priced it in, and those are not seeing that increment in the share price of Dangote. This guy says, what should be a good yield to maturity? Yield to maturity is calculated based off the coupon on that bond. So if it's a 2% coupon and the interest rate goes up, you can calculate that with certainty and say, this is the yield to maturity. So the point I'm making is that the coupon on the bond is not going to be your real return. It is a yield to maturity or yield to call that's going to give you the real rate of return based on the prevailing interest rate. So ask for those two. Don't just ask for the coupon, right? That's the point I'm making. So the yield to maturity is synonymous with interest rate when it comes to bond. No, the yield to maturity is that coupon rate that the yield to maturity reflects the change in the interest rate. Let's put it that way. The coupon is just what you get that they will pay to you. So, but when interest rates change, it affects the coupon. It affects the real rate of return coming to you. If interest rates go up, like I said, if interest rates go up, what happens to the yield? The yield will go down. It's inverse relationship. So the yield to maturity is basically the real rate of return because it's taking into account the change in the interest rates of those underlying bonds. Yeah. Okay. For irredeemable bonds, how do you calculate yield to maturity? Well, do you want the actual calculation? What do you mean irredeemable bonds? All bonds are redeemable. All bonds are redeemable. It may take 100 years, but all bonds have a maturity date. Remember what I said about bonds? They have a maturity date. Yeah, I think Europe has now 100-year bonds, but it's a 100-year bond. Yeah. Okay. Thanks, guys. Great questions. Yeah. Talk about treasury bills. I did, right? So I talked about treasury bills and all that. So thanks for that. What do you have to say about investing in the Nigerian stock market? Nigeria is an emerging market. If you invest in Nigeria, you get a higher return. That's per se, because it's termed that the market has a longer way to grow and has a lot of inefficiencies. So those inefficiencies become volatility or profits, more or less. That's the thinking. Last year, the Nigerian stock market was the highest in terms of the return of the index in the whole world. So if you had bought the index, i.e., you had bought the index from January 1 and you held it all the way till December 31st, your return would have been higher than the US markets, the British markets, Japanese markets, and even the Chinese market. So that's what I'll say about Nigerian stock market. But you are earning in Naira. So if you're in Naira, the currency is also being depreciated. So you have to take that into consideration as well. So I would say there are good parts and there are bad parts about investing in the Nigerian stock market. Choose and do as what fits you. Yeah. Can shares be bought at any point in time or during public offerings only? When the public offering simply means it is the company selling shares, right? Anytime you want, you can buy shares by simply going to the stock market, and a broker can buy shares for you. So if the company doesn't advertise the shares, it's a private placement. They're not allowed to advertise private placements. But once the shares have been sold, remember when MTN was selling the shares, it was very, very hard to get MTN shares because that was going to be like more or less, it was a shares price to a share sale to investors, sort of, yeah. But if you want to buy MTN today, you can go to the broker and tell the broker, I want to buy MTN shares. And if it's available on the market, then someone can buy that for you. Can you please explain more on the overbought and oversold items as regards to stock? When the market is overbought, that means people are trying to buy it. So demand is up. So the prices go up. That's basically all it's saying. If the market is oversold, people are selling. So the supply is up. So the price is going down. Once there's high demand, the stock price is going to go up. When demand or supply is high, the stock price is going to go down. So that's basically what that overbought and oversold basically means. So you want the stock price to always be paid or to always be sold. You want to know what that means. And then you say, okay, if it's oversold, I can buy in now. If it's overbought, oh, I can sell now. If you're a buyer or a seller in terms of meeting your own objectives, that's basically what that means: overbought and oversold. So Trove and Bamboo are trustworthy platforms to register as a novice. I use Trove, so that's what I'll answer. Yeah. Can you explain the importance of yield to maturity again to an investor as against its coupon? The coupon will never change. The coupon is what's on the bond. It will never change. If they say 10%, it will never change. You'll get your 10% every month. But that 10% could be less or more in quote if the interest rate has changed. Look at it this way. If you are getting 10%, and maybe let me use an example that is not really accurate, but to explain better. If you are getting 10% and dollar was 300, and you get 10% and dollar is 400, is it the same 10%? On paper, it's the same 10%, but one 10% is to turn the dollar, on that 10% is to $400. Does that make sense to you? I know it's not accurate. I'm not trying to say interest rate or exchange rates are the same. No, I'm trying to kind of give an example. Because the interest rate will change, then the actual yield is going to change. That's the point I'm making. The actual yield will change. Yeah. What makes shares depreciate in value? Supply. If there's an oversupply, then the share price will go down. So the question is, why is there an oversupply? Why do people sell shares? Bad news. If people think there's bad news, there's scandal, people think there's fraud, or people think that the sector the company is in is not going to grow. So, like, imagine if you were a company like ExxonMobil, and right now everybody's doing green this, green that, green this, green that. Your shares are going to keep on going down in price. So you see, Exxon shares are going down in price, because everybody's buying electronic cars. Nobody wants to do oil and gas anymore. So sell, sell, sell. That's making the share price depreciate in value. Can you advise on how earnings per share or PE ratio can help inform on what stocks to buy? Like you said, they can only inform you. Let me talk about PE ratio. The PE ratio simply means the price to earnings ratio, right? The price to earnings ratio. All it tells you is that how expensive the stock is. When you see a PE of 10, what it means is that you are buying 10 times the earnings of that company. So when you buy the company, you are buying 10 times that earnings. That's what the PE means. So if you see two companies with the same price, but what's it called? One stock has a higher PE, then the one with the lower PE is quote unquote cheaper than the one with the higher PE. That's basically what the PE ratio means. It just gives you an idea of how many times of earnings you are buying. EPS is just simple. I mean, if you have a stock with a high earnings per share, that means per share you're earning a very, very higher rate. So if I was going to buy a share, I want to buy a share with a high EPS, but maybe a low PE. That's how I'll say. So high PE, low PE. That's what I would recommend. But it doesn't really follow because Tesla has a very, very high PE. So that could be because Tesla is growing very, very fast. But it's just a guide. Yeah, it's just a guide. You have to do much more research than that. How do you know that a share will appreciate in value in future? Nobody knows. Nobody knows if a share will appreciate. That's the point I'm making. You can estimate and have your calculation of intrinsic value and then take your position based on that, but nobody can know for certain. You can have your own idea and based on your own calculations, make your investments, but it's really good to be at it because no one can tell the future. Yeah. No one saw COVID coming. And COVID has affected everyone. Yeah. When you buy shares via the index, do you still make a profit if the company's shares amongst the various depreciate? It depends. If more companies depreciate, then you make a loss. Look at it this way. The index has Apple, the index has Tesla, the index has Netflix, yeah? But the index also has ExxonMobil. ExxonMobil is going down, but Tesla is going up. So if Tesla is going to go up, it can pull Exxon up and make a profit. So it depends on what index and it is and how the index is configured. Is it going to be an equal weighted index or is the index going to be like a cap index? That's basically what it means. Yeah, you can buy a technology index alone or you can buy a banking index alone. You can do that. Yeah, I think AfriInvest has a banking index. You can just buy that index and say, yes, I'm just exposed to Nigerian banks. Yeah, great. Is crypto a good investment, and how can one go ahead buying them? Crypto is a commodity. It's the share price is on a tier. It's rising. If it's good or bad, we will know afterwards. How can you go about buying them? I think lots of apps have them. Lots of Bitcoin, lots of Binance, Ludo, lots of fintech apps offer cryptocurrency. Just do some research, and you'll find tons of ways to get Bitcoin. Yeah. Why is the government's return so low at the moment? Because interest rates is the cost of borrowing money. So right now in Nigeria, there is too much liquidity in the system. There is so much money in the bank, so much money that the federal government does not have to pay to get money, in quote. That's what the interest rate means. When interest rates are high, it means that there is not a lot of liquidity in the system. So if you want money, you have to pay to get money. So you pay a higher rate. But when interest rates are so low, it's because the government has so much ways to raise more finance that is then paying so little to the investors to give it money. And why is it so low, to answer your question? Because the other side, maybe before the stock market returns started to boom, you can see that the government rates were very, very high. So when the fixed or the risk-free rate in Nigeria was very, very high, the stock market was not doing that well because people were not taking risks. But then when the government dropped the risk-free rate to less than one, then everybody went back to the stock market. Then the stock market grew up, basically rose, and the index became the best. So the government returns are so low because the government has a lot of cash. If it has a lot of cash being given to it, why should it pay much for money? What is a REIT? REIT is a real estate investment trust. It's like an index or like a company or like a fund that buys properties and then gives you the rents of those properties as a dividend or as a return back to you. That's what a REIT is, real estate investment trust. How does the MPR given by the CBN affect the business in aspect of its shares? I don't understand the question. I don't understand the question. Yeah. What are the rules on share buyback so it does not influence the price more than should be since it says a company? Yeah, but the point of share buyback is you are giving a return to the investors, not to Dangote. Dangote cannot buy back all his shares. He can only buy back 15%, I believe. But when he buys it back, who makes the money? The shareholders, right? Because the shareholders' price goes up. So that the rule is that you cannot buy more than 15%. And he bought 10%, I believe. And then the shareholders then made a lot of money as well. So that's the main rule in share buybacks, yeah? Is there a way to determine the intrinsic value objectively, scientifically? Yes, there are many ways to determine intrinsic value. But the point I'm making is this. The intrinsic value is a future calculation based off past events. That you can be accurate, you can be wrong. So there are calculations, but it's always going to be based on an assumption to say, hey, we think that this is going to be the return or that's going to be the return based on what we're saying. So you cannot be 100% correct, but I think it's always good to calculate that than not use it. That's what I'll say. Are there models to calculate intrinsic return? Yes, there are. Just Google it. Google calculate intrinsic return. You see lots of offers. Yeah, Google calculating intrinsic return. You see lots of calculations there. Options and futures is outside the scope of the lecture. I don't want to confuse people. What's the least amount you can invest? It depends on the share price. If the share price is $10, then you invest $10. That's going to be the least amount, right? If the share price is $1, then you invest $1. But the indexes, those ETF guys have what's called fractional shares. So the ETFs can allow you to trade the units, the little $1 units of those shares. So I think the best answer is if you go online to maybe those apps, you try and put in $10 or $100 and see what's going to be the minimum for you. It's going to be share by share would give you a minimum that you can invest, or ETF by ETF, basically. Yeah. How can you access companies available for share sales? If the company is listed on the stock market, then I think the shares are going to be available unless it's very, very scarce. But if it's listed, that's a good step to say, yes, it's available. Where do alternative investments fall? Real estate, digital currencies, those are going to be very, very risky. So real estate is always going to be location, location, location. If you have real estate in your village and real estate in Lagos Island, those are two different real estates, yeah? But digital currencies are always going to be risky. So they're going to follow that risky path. So they give you high return, but there's also a lot of risk that you basically have when you hold those portfolios with you. How does one buy the VTI? Go online or get an app like Trove or Bitcoin or Robinhood. You can buy VTI online. It's basically there, yeah. How can I join Telegram group? Yeah, come on Twitter. I'll give you the link, yeah. I would appreciate if you would show the screen for the things you have to consider before you invest. Can you be more specific? I'll show the screen. Yeah, that's no problem. Just give me the screen you want to show. I'll show it. Can you drop the links to your podcast and Telegram group? Yeah, I put the podcast links there and I'll put it on Twitter as well. Yeah, I'll do that for you. Yeah. You are welcome, guys. Thank you so much. Yeah, I appreciate you guys. What portfolio will you suggest for a person in age 25 to 40? An aggressive portfolio. If you are age 25, 25 to 40 is a wide gap, but if you are 25 to 40, go aggressive. I mean, I can't give you advice, but I would say if I was 25 years old, I will do more equities because that's where the capital appreciation potential is. So I will do more equities, and as I get older, I'll start do more bonds. So yeah, if you want to, if you are younger, you have the advantage of time. I'll take advantage of that time and do more of equities. That's what I'll say. Yeah. And Telegram group, I have a Telegram group that does all that for you guys. Yeah. Can you explain the difference between treasury bills and government bonds? The difference is just the tenure. Treasury bills are 91 days. Government bonds are mostly like 2 years and above. How can someone invest in government treasury bills? Just talk to your broker or your banker. They have all that with them. Talk to your broker or your banker. Yeah. Can I recommend books? Yes. If you go on Twitter, FinPlan Books, I have them there. I'll put, if you go on Twitter, I will put, I have a hashtag for books. I recommend books every month. I have a hashtag for that. Yeah. And you can see it right there. Which apps do you recommend to buy ETFs, NFC? I use Trove and Robinhood. That's what I'll say. So you can use any of them. There are many of them, but I use Trove and Robinhood. And Bitcoin is outside the scope of the lecture. Can you touch on the portfolio percentage again for the conservative, moderate, and aggressive? Yeah, I can do that. Let's go back. Let's go back to the chat where we talked about, you want this guy, right? So in this, I'll leave it up like this. So the aggressive guy is basically trying to, he's got 10 years to retire. The green is cash. The red, this red right here is equities. This green right here is cash. So you see he's got more than 10 years to retirement. So he's taking a very, very aggressive approach by saying he's going to do 50% in equities right here. But then as he's getting older, he's transiting from equities into cash to basically secure his cash flow, because when he's get to retiree, he's going to do a lot of spending. He doesn't have the time or the risk profile to take risk. So this is just basically what he's doing in this instance here, moving on from high risk to lower risk. And then as he's getting older, you can see he's taking this 20% here to 40 here and also 40 here. That's basically what he's just trying to do. All right, let me see, guys. 19. Yeah, I'll post the Telegram group and I'll post all those apps. I'll post everything. Yeah. Counter stock. I don't know what a counter stock is. Yeah. Can a private company send out IPO? No, because it's private. If when you do the IPO, then you become public. Yeah. So the private company can do an IPO, public offer. It then becomes a public company. You get it? So if you're private, you do the public offer to become a publicly quoted company. Yeah. That's the answer to that. Sure, no worries. Can we buy shares before IPOs? You can buy a private placement, but you have to know, you have to be what's called a qualified investor. You have to have a lot of money because you have to understand what you're doing because it's called a private placement. It's not so it's not easy that I'll say, but you can, yes. Sometimes people sell them. If you know someone selling, he can sell to you, but you have to be a qualified investor to understand what you're doing before you invest because there's less liquidity when you buy a non-IPO stock or non-publicly traded stock. Yeah. Please advise on reliable platforms. I just said I use Bitcoin, I use Robinhood and Trove. That's really what I can say. I can give you guys, I can share my whatever after the session, but that's what I use. Yeah. I'm going to put the audio and I'm going to put the video on YouTube and on Twitter as well. Yeah. How does the beta of an equity relate to the market? The beta of a company is outside the scope of the lecture. The beta simply means how the share price, the sensitivity of the share price to risk, but that's outside the scope of the lecture. What's in Telegram? Telegram group's name is InvestHut, InvestHut. Can you advise one to invest in Bitcoin? I don't give advice. Do you compare P ratios for similar companies? Yes, you want to compare PEs for similar companies. It gives you an idea. The PE ratio, the price earnings ratio, tells you what amount of earnings you are buying. So a PE of 10 means you are paying for 10 times the current earnings of the company. That's basically what it means. It's like you're paying for Messi 10 times the number of goals he will score. That's just, if I can use that example, yeah? That's what the PE does. PE helps you know if you are paying too much or paying too little, yeah? If I want to invest in rates today, how do I go about it? There are three rates in Nigeria. There's the UPDC rate. I think there are two more. I'm not too sure about them. But if you just Google REITs in Nigeria, then talk to a stockbroker, they'll just get you, the REITs in Nigeria are quoted. So it's easier for you to buy them on the stock Nigeria Stock Exchange, yeah? If I want to invest in a tech index, which platform would you please recommend? Any platform. So I think Robinhood or Trove, they might have a Google an ETF, technology ETF. When you get the name, then go to the fintech app and plug in and buy. That's basically what you do. So Google the fintech, say ETF for technology. Then you get the name. There'll be many. You get the name when you want. Then you go get it. I like the Vanguard ones because they are cheap. Yeah. Yes, you will get the recording. Guys, we're gonna wind down now, right? We're gonna wind down. Please explain the interface between the retail and the broker. It's the same thing. It's like buying a ticket. Before we used to go to the airport to buy tickets. Now we buy tickets online. It's the same thing with fintech. Now you don't have to go to the stockbroking arm to buy a share. You can log into your fintech and buy a stock. I think the technology has made it easier, faster, and better. Yes, I'll post the Telegram group. Yeah. VTI is just an ETF. Just Google VTI. It just explains it to you. Just Google it, yeah? The color purple and blue is all the blue guys are going to be fixed income. So as the guy was aggressive on the left-hand side of the chart, the aggressive side, he was doing equities. As he got older, the green and the blue are the fixed income. Yeah, I'll try and put that chart on Twitter. If you go to Twitter, I'll try and put that chart on Twitter for you. Yeah, I'll put it on Twitter for you. I will put the Telegram group also on Twitter, guys. Mutual funds or index, it's almost the same thing. Mutual fund, when you can buy a mutual fund and invest in the index, you can buy an ETF and invest in the index. So the index is the item. The mutual fund is maybe the vehicle to get that item. Yeah. Almost done, guys. Yep. Thank you so much, guys. I appreciate you guys for staying so late. Thank you, Arvin. Say thank you. I appreciate that. What's a coupon? A coupon is a dividend paid on a bond. That's a coupon. Dividend paid on a bond. Thanks, guys. You guys have been wonderful. I'm going to shut down now, and then we can talk on Twitter and the rest. I appreciate you guys. Have a good day. Love you all.